Hey, ladies and gents. Hope you're doing well today. Just wanted to talk about Palantir for a few minutes here before they have their earning report in a couple of weeks. So they closed out yesterday at 34.05 closing price. Now, looking at the options for February the 19th, we can see that they have an expected move of $7.20 in either direction. So the upside by Friday, February the 19th would be 41.20 approximately, and the downside would be 26.80. The potential move for that same expiration date is $9.20 in one direction. So we can see that the upside is 43.20, so right around their all-time highs of 45, and the downside is 24.80, which is not too far from the support level of 22.50 or so. Now, the historical volatility on Palantir, and keep in mind it's only been trading for about 4.5 months or so, is 128.32%, and the implied volatility is 122.3, so roughly the same overall. The implied move each day based on this implied volatility is 7.64% other direction. The put to call interest right now is 0.87, so roughly the same amount of puts are being bought to the same amount of calls being opened up as well. The 1 year high, as I mentioned, which is only about a 4.5 month high or so because they've been trading since late last year, is 45 back on January the 27th, and the low was $9.18. So I'm going to give out three different ideas here on trading for Palantir. Keep in mind that we have earnings coming up on February the 16th, which is a Tuesday, before market open. And also keep in mind that Palantir insiders were able to sell just 1/5 of their holdings when they direct listed. So right now, they can sell 80% of the remaining holdings after the lockup expiration, which occurs on February the 19th, which is a Friday, right? This expiration date. So we're going to see a lot of volatility on Palantir likely into expiration here. There are three different ideas on how to trade this, depending on if you're bullish, neutral, or bearish, right? If you're bullish, you can purchase a 35.40 call spread, a bull call spread, for a net debit of $1.32, and then sell to open a $30 cash secured put for a credit of $1.55, right? Keep in mind, you need to be okay with owning the stock below 30 in order to do this trade, because you will be assigned 100 shares per cash secured put sold. And so this overall trade generates a net credit of 23 cents. So if Palantir stays between 30 and 35, you gain 23 cents net, right? The maximum profit on the trade is $5.23, given that the maximum spread on this trade is $5 and your credit already received is 23 cents. So if Palantir goes above 40 at expiration, you make $5.23 net, and your risk right now is a net credit right overall. The actual true risk is owning the stock below $30, right? Your actual effective price would be 30 less 23 cents, so it would be $29.77, right? That's a bullish trade idea that I have right now. And again, everything discussed here is for educational purposes only. So just do your own homework, make your own decisions for yourself, right? I'm just talking out loud here, right? The neutral trade idea for the same expiration date is to purchase 100 shares of stock at the current price of around 34, right? And again, I would say purchase half your position at this price if you want to use this kind of strategy, right? Because the whole idea here is you're going to buy 100 shares per lot you want to buy, right? And then you're going to sell a cash secured put at the 30 strike as well for $1.55 credit, right? For the second lot that you wouldn't mind owning on the stock, right? So for example, if you want to own 200 shares, you buy 100 shares, you sell one cash secured put, right? And then you simultaneously sell a covered call at the 40 strike for $1.90, right? Because you own 100 shares, you're able to sell a covered call as well. So this is called selling a covered strangle, right? You're selling the cash secured put and the covered call at the same time. The whole idea here is to take advantage of the high implied volatility prior to the earnings event, right? And then so what happens here is that your effective cost basis is 34, which is the price at which you bought the stock at, less $1.90, right? For the covered call premium, less $1.55 for the cash secured put premium. So your effective cost basis here is $30.55, which is about 345, 345 below the current price, right? Now, if Palantir trades below $30 at expiration, 100 more shares will be assigned per cash secured put sold, right? Which will bring your effective cost basis down to $30.28, right? If Palantir trades above 40 on expiration, the stock will be called away for a realized gain of $40 less 30.55, which is your effective cost basis, for a gain of $9.45 per contract or per 100 shares you own, right? This will represent a two-week holding period return of 30.93%, which is not too shabby, right? The last idea here is a bearish idea, right? Again, I'm bullish myself on Palantir, right? I like it longer term. I think it's going to be a very strong performer over the next 2 to 5 years. But that being said, in the short term, it's anybody's guess where it goes, right? Again, the lockup expiration is 2 Fridays from now. It could drop, a fair bit, but if they have strong earnings, it could also pop and then drop, right? Who knows? Anyways, the bearish idea here is for the same expiration date. And this is a put ratio spread where you buy the 32 strike put and you sell 2 of the 28 strike puts for a net debit of 71 cents, right? The first break even on this trade is 32, your long put strike, less your debit amount of 71 cents. So your net break even here on the first break even is 31.29. And then your second break even on this trade is the short strike less the spread width of $4. So 28 minus 4 is 24, plus the debit amount you paid, so 71 cents. So the second break even is 24.71. So anything between 24.71, that area is a second break even. The first break even is 31.29. Your maximum profit is achieved if the stock price lands smack dab on 28 at expiration, right? In that case, you make a return of $3.29, right? Profit overall. A key factor of this trade, though, is that the trader has to be okay with owning Palantir stock at 24.71 since 2 puts have been sold while only one is owned, right? So you will be assigned 100 shares per cash secured put sold in this case, right? The second put of the put ratio spread. So here's some ideas for modifications on the trade as well, right? For the bullish idea, you can turn the bull call spread into a combo spread by selling the 45.50 call spread prior to expiration if Palantir rises above $40 prior to the earnings, right? As this will greatly reduce your net debit on the position overall. And then for the neutral idea over here, if Palantir trades below $30 at expiration, you can sell covered calls 1 month out above the break-even price to reduce your cost basis even more, right? For the bearish idea, you can close one of the short puts out if Palantir trades higher prior to earnings, which will remove assignment risk on the second put that is sold, right? And again, remember that earnings are on the 16th of February, which is a Tuesday, before market open. And also remember that lockup expiration for 80% of insider shares is Friday, February the 19th. So if you're profitable prior to the Friday, it's not a bad idea to exit your positions prior to that event because it may result in more volatility, right? Again, do your own homework. Make sure you understand what you're doing before you place a trade. These are just ideas to be discussed for learning purposes only. If you have any questions at all or comments, please drop them below. And if you like the video, please subscribe and share with a friend. I appreciate that. Thanks a lot. Have a great day and bye for now.